Good morning and welcome to Navigating the CARES Act. I'm Aubrey Albrecht, MHA's Vice President of Education and Chief Innovation Officer. Happy to do the introduction and moderate questions for today's webinar. I want to give a big shout out to our sponsor for today's webinar, Quality Furniture Rental. Our sponsors make it possible for us to put these webinars on for free for our members and non-members, and we appreciate their partnership for this very important and timely topic. Just so you're aware, this webinar will be recorded and made publicly available on MHA's YouTube channel. We stress that this webinar is not to be construed as legal or operational guidance. Instead, it's meant to be a starting point for your company-specific plan. We encourage firms to seek expert consultation in the development of their plans to ensure comprehensive coverage. Also, because the situation, aka COVID-19, the pandemic, is evolving rapidly, the information in this webinar is the best available resource at the time of the webinar. The views that will be expressed in the webinar are attributed to the individuals expressing them and do not necessarily represent the views of MHA, its members, board of directors, staff, or sponsors and participating companies. So now I will introduce our panelists. First, we have Brenna Ramey. Brenna has over 15 years of human resources experience in the industries of hospitality, retail, multifamily housing. Brenna has worked on a variety of organizations in size ranging from less than 20 to over 300,000 employees. She's currently with Abdo, Eck & Myers. Second panelist is Matt Goldfein. Matt is an attorney at Burdick Lifson. He represents clients in the areas of creditors, remedies, and real estate, including matters related to multifamily housing. During the pandemic, Matt has worked closely with property management companies and owners of apartment buildings to navigate the new restrictions in place for residential rental properties and come up with solutions to address new issues arising during these rapidly changing times. And last but certainly not least is Jody Nielsen. Jody is a national senior account manager with Cost Segregation Services. Jody offices out of Minnesota. She oversees the engineer-based cost seg studies for her clients. The studies provide additional tax benefit for building owners by the acceleration of building's depreciation. Jody provides the complex information in an easy to understand format, assisting owners take advantage of the additional cost segregation tax benefit opportunity, which enables them to use their money to grow their business and make more money. Is a blessing she enjoys every day. So, one more shout out to our sponsor, Quality Furniture Rental. And at this point, I will turn it over to Jody. Thanks, Jody.
Thank you. I'm looking for there we go. Well, thank you very much, Aubrey, for inviting me, and I'm looking forward to hopefully giving some good information along with Brenna and Matt to all the members out there that are listening to this. Using the CARES Act, hopefully that's going to bring some great benefit to you. So, there we go. So obviously Forbes says COVID-19 outbreak has seriously impacted the revenue generation of small businesses. And for the audience we're talking to today, I'm sure that's mostly with rents and not being able to evict. And so the CARES Act right now, for what we're going to discuss, allows for a net operating loss for you and your buildings that you own. What we're going to cover today is your strategy on depreciation, your expense and capitalization strategy. Do you know the current CARES Act legislation, how it could benefit you? What is partial asset disposition, and did you use it for your remodels and renovations? The difference between CSSI and a CPA, difference between passive and active income, and as a real estate investor, how grouping elections may benefit you. So I'm going to start with just a quick little story here. I don't know if anyone's ever heard of Ira Yates, but he was in 1926. He owned a bunch of land in Texas, and he was dirt poor. He had a wife, kids. They were just not making it. It was a bad situation. He was approached to have his land drilled on, and lo and behold, that was the second biggest oil pool found in, I believe, U.S. history to date. And so he became a millionaire. And that's kind of what building owners are. You're sitting on your money right now by owning a building. There's money within it. You just have to get it out, and that's what we provide. So cost segregation, or what a cost segregation study provides, I should say. So cost segregation is nothing new. It's been around since 1997, and what it is, it takes assets and it takes assets that are 5, 7, 15 year, and 27 year, and you're able to accelerate anything under the 20 year. The CARES Act has been really beneficial because this allows our study to create a net operating loss for tax year 18, 19, and 20, and you can apply this back 5 years, so it's a cash refund. So this has been super beneficial for many people. And that we're going to get into a little bit further. Tax Cuts and Jobs Act came out in September 27, 2017. And basically the biggest benefit for anybody is at that point, any building bought or built gets 100% bonus on anything under a 20-year life. So again, that goes back to the foundation of the cost segregation. What falls into that category under a 20-year life that you can bonus depreciate and also get accelerated depreciation. And then the tangible property regs, or TPR regs, or repair regs, you might hear it anyway. This is really important for apartment owners, hotel owners, because you're constantly doing things to your property. And this allows you to make expense calculations instead of capitalized calculations. Where's my little arrow? There we go. So what is cost? Oops, sorry about that. So anyone listening to this over 40, you know the 2 whole beef patty, special sauce, lettuce, cheese, pickles, onions on sesame bun. Anyone under 40 is probably going, what does that mean? And it was a tagline for McDonald's that everybody knew. But it's a good example to show a straight line Big Mac hamburger is $3.99. We break it all down, and that's what we do to buildings. It's breaking everything down within the building. So cost segregation, like I said, it's been around since 1997. It's results in lower income tax, and it's a building system valuation within your building. So you're getting to use your money now instead of waiting. So like clients have told me, it's an interest-free loan to myself and not to the IRS. That's true. And someone else said, hey, I think I know how to use my money better than the IRS does. And I would believe that's probably true for most people as well. There are little, some false claims maybe that it has to be at least $1 million building. It has to be new. That is not true. You can go as low as $200,000 for the tax benefit to outweigh the cost of the study. And I want to make clear that, you know, we're not getting more depreciation for you. What we're doing is we're just accelerating, front loading it. So think of it like if you won $1 million in the lottery, you would, if you want it all right now, or a bunch of it now, or you want it over 27.5 years. Well, you want it now because time value money. So what is 5 and 7 year property? So, you know, a lot of these things you're going to have: carpeting, flooring, interior doors, kitchen fixtures, countertops, etc. 15-year property, you're going to have a lot of these things, you know, paving, fencing, parking lot, signage. So I don't know if you can see, but the blue line here is straight line depreciation. The red line is accelerated depreciation on anything under 20-year life. And then the green is bonus depreciation. Again, anything under 20-year life. So when you get a study, it's going to have everything broken down with a percentage that's given to each of these dollar values. And this is what's going to be very important for your tax professional, because this is what they're going to use to make TPR decisions or repair reg decisions in your favor. Tangible property regs, why this is important to you is this is no longer a guessing choice for your CPA. This is something the IRS, there's new rules and they have to be followed to make sure that you're compliant and that you're going to be audit defended or protected. Cost segregation is the certain method that the IRS does prefer that everybody uses. When they say prefer, that's what they'd like, and it's simply because it's a third party, non-biased mathematical decision. The Journal of Accountancy is kind of the Bible for tax professionals, and they said after nearly a decade making final tangible property regs have arrived, these regulations will affect every taxpayer that uses tangible property in its business. And again, that is multifamily and hotels, especially any building owner, but those are, you guys do things all the time to change your buildings. So here's an example what this means to you. Our study will come in and we give the whole system, this example, an HVAC system with $70,971 value. The TPR regs say if what you do to your system or your building is less than 33% of the whole, you can expense. So using this ratio, you did $19,000 on your HVAC, divide 19,000 into 70,000, that gives us a 27%. So Tess says to the CPAs, expense this. Now, the other reason that it's important after you've had a cost seg study, anytime you have a contractor do anything to your building, you definitely want them to say three things when they break down whatever they're doing. You want them to do tear out, disposal, and replacement. And the reason this is important is in this example, if you would have used the whole HVAC system and replaced it, you would have been able to expense part of the tear out and disposal because a value had been given even though you were tearing it out. Now you would have had to capitalize the whole new system, but anytime we can expense something, obviously we all agree probably it's better. So here's another example. $100,000 roof repair can be expensed as long as the roof material is not materially better, does not affect the rest of the roofing system, membrane, trusses, etc., and is more than 2 years in occupancy. The roof was capitalized over 39 years. The owner would receive $2,531 in income reduction per year at a 37% tax rate. That's only $936 back in cash a year. If we expense the entire amount the current year, that's a $37,000 cash back in the current year. And the other good thing about TPR regs is the IRS this is very favorable to you. They will allow us to go back and scrub your depreciation schedules to find out things that are right now currently have been being capitalized that should be expensed, which is another good value for you. So the Tax Cuts and Jobs Act, this came out September 27, 2017, and why this is really great is prior to that, you had to have built something new, and at that point, you were only getting 50% bonus depreciation. When they came up with this, it said, hey, as long as it's new to you, 100% bonus, and that's great because you could buy a 100-year-old building. You're going to get the same benefit as someone that just built a building. Now, what they didn't do on the Tax Cuts and Jobs Act is QIP, which probably won't affect too many of you, but qualified improvement property was supposed to be put into a 39-year, or excuse me, it was supposed to put in a 15-year straight line, and they put it into 39-year. This has been improved or corrected through the CARES Act. And again, for every $500,000 to $1 million building, the tax benefit being brought to you is going to be $40,000 to $80,000. So the CARES Act, the net operating loss, and this qualifies for tax filing in 18, 19, or 20. So in this example, a $425,000 NOL carryback, net operating loss carryback, was provided with a study. And in 14, you can see they were doing well. They paid taxes, 15 and 16. So this totals the 425,000, giving you a refund of $115,677.50. Now, that would probably benefit a lot of you right now with the struggle that you're probably having with back rents not getting paid and tenants not moving out, etc. So the CARES Act, again, corrected that TCJA, the QIP, as we mentioned, gives you a 100% bonus, and you can retroactively apply bonus creation to QIP if that would be something you'd have. We can look at that, which is awesome, good for you. The result is this increases your loss to offset gains and could either reduce taxes now or create an opportunity for a refund now. So this was put into place for this part of the CARES Act to stimulate the economy and give building owners, some benefit, hopefully, that they can use. So partial asset disposition. Partial asset disposition has to be taken the year it's done. So if you've done any major improvements this year, you should really look at this. We call it dollars in the dumpster. Anything that was put in the dumpster and taken away, there's a value to it. You have to have been in the building for more than a year. But the good thing is you can get the partial asset disposition benefit, and then you can also cost seg the new improvements that you did. And I should bring up, cost segregation is not a one-time thing. You could cost seg a building, 5 years ago, and you do some major improvements, come in to get the pad, get the cost seg on the improvements, or let's say you own a building and you sell it 5 years to your niece or nephew, and they get the stepped up basis, and then they can cost seg it IRSs as a new owner. Or it can be a tax strategy for estate planning too. You can put the building into an estate. The estate gets the cost seg tax benefit when the person passes away. There's no capital gains to the inheritors, and then whoever someone inherits the building again, then they can cost seg it under their name. So again, I'm not a CPA, nor am I an attorney. It's something to talk to them about, though. I just want to give you some information. Sometimes I hear, my CPA's already done this, and again, they do a great job. They are fantastic. They have 200 clients like you, and they have so many tax laws that are changing, and everybody's situation is different. They're not doing their job. It's just I've never met one that's an engineer. So for us, we can look at your schedules and just see if there's anything that's been left on the table. This example shows $42,000 more additional tax benefit. I don't want to trigger an audit is something I hear. Actually, we've done over 28,000. We have never triggered an audit. In fact, your audit defended no charge for the life of your building, that you own it. And we've been involved in maybe 17 audits, I believe, at this point, and we're in and we're out. You don't have to attend. Your CPA doesn't have to attend. They know, IRS knows who we are. And general accountancy, again, that Bible, cost segregation technique is no more aggressive than using a permissible depreciation method under the IRC. And then you probably all know who Dave Ramsey is. Cost segregation is a proven tax strategy. So here's an example. This is a duplex for $460,000. It was purchased at a tax rate of 37%. The no charge analysis was showing a $96,000 NOL or a $35,000 tax saving benefit against the tax liability that year. Cost of the study is $39.80, post-tax $25.07, ROI showing 14 to 1. Now, our studies aren't always the same price. People ask what that's based on. Cost seg studies are based on type of building, how big it is, usage of it. So there's a lot of how many different, swimming pool, workout room, community room, indoor, outdoor pool, underground parking, that type of thing. So this actual client, land does not count, and that's why I like this example. So they had not taken out enough land. So the building itself value was only really $440,000 when we got into it. But we still were able to get them $53,000 tax benefit or $143,812 carryback. Same price, ROI 21 to 1. So, you know, how if you want something to be looked at, you know, it's very easy, a depreciation schedule or closing settlement statement if you just purchased it. Obviously, most of your type of buildings are going to be multifamily, but you might have some other types. Building costs without land, your month purchased, and then if there's any major improvements. So that is my information. If anybody would want to get in touch with me, and I know we're going to be doing the Q&A after, so I look forward to hearing Brenna and Matt. Thank you, Aubrey.
Thank you, Jody. All right. Again, if you have any questions, feel free to put those in now, or you can put them in later when we open it up for Q&A at the end. So at this point, I am going to give Brenna control.
Good morning. Well, I like to be in control for those of you that I've previously worked with. So you all know I'm happy to be in control. I'm glad to be here today. As Aubrey said, I work at Abdo Eike Myers on the HR advisory team. But a little known fact is that I spent 4 years in multifamily housing. So I have just a really sweet spot in my heart for this industry. And my dad is an owner of 20 residential buildings. So I feel like I've grown up knowing this and talked about it, and I know the challenges are a lot. So I'm going to talk about a couple of different things today. And Matt, Jody, and I, when we were prepping our presentations, we all agreed that each of us could spend a whole entire presentation just on our one subject. So my goal today was to really fly at 20,000 feet and to talk about each of the major things that have happened over the last 7 to 9 months that are affecting how you manage employees, payroll, processes, benefits, COBRA. And as Aubrey said, any questions that you have, please feel free to shoot them out there. I'm not going to go too deep into any one topic just to respect our time, but I will talk about each one. So the most common question we're getting these days right now is about President Trump's executive order that happened in the beginning of August and went effective September 1st, which is about the payroll tax deferral regarding Social Security employer paid benefits. So what's really important about this executive order is 2 things. The first is that the word deferral is extremely important because that's what all of this is about. All of the conversations that have happened since this came through has been about the deferral piece. It's not forgiveness. It's not a payroll tax forgiveness. It's deferral. The second is there are way more questions than answers when we get to what this means. So at a high level, President Trump's executive order said, hey, we're going to defer the employer, essentially employer withholds and pays the Social Security tax for each employee. And he deferred that through the end of the year. He did not forgive it because he doesn't actually have the right, no sitting president does. That has to be done through an act of Congress because of the way the system's set up. So right now, the program is set up as a deferral. The only way that will be forgiven is if there is an actual act that forgives those deferrals. President Trump has said if he's elected, he's going to push for that. But again, that's not necessarily in his purview to be able to have just happen. And he hasn't stated what would happen if he wasn't elected. So a couple of things have come out. The IRS gave some updates to the information on August 28th, just in the nick of time before September 1st. That gave us some clarification, and it kind of affirmed some of the beliefs that in the HR and payroll community we had about this. And what it clarified is this. It truly is a deferral, meaning that the amount of money that would be taken out and paid is not forgiven, it's just deferred. So let's say you don't withhold that from an employee's paycheck as an employer, and that doesn't get forgiven in 2021. As an employer, you would still be on the line for actually paying that owed Social Security tax for that employee. So essentially what his executive order did is created, as the employer, you being the owner of a loan to each of your employees that you are liable for if you don't withhold that. So they did say that, let's say you decide to do this withholding, you say, we're not going to withhold, we're going to defer withholding the Social Security tax from employees. And then for whatever reason, either President Trump is not reelected or he is and he's not able to get this passed through an act. And so it doesn't ever roll over into a forgiveness. It only ever stays a deferral. What the current executive order and law would make happen is that all of those deferrals would be due by the end of the first quarter in 2021. If you didn't withhold it from employees and that employee is no longer there at the organization, let's say they resign, are terminated, something happens in that time frame, as an employer, you're still responsible for paying the government that money that's owed, and then you as the employer are responsible for recouping that money from the employee. So essentially, it just makes you somebody who's responsible for a loan to an employee. So there's a lot of other really interesting things around it. They did clarify that if you withhold it from the employee, you do have to pay it right away. So initially, some employers thought, well, because I'm going to be the tax, essentially the tax person that will be responsible for it, I'm going to withhold it from employees, but I'm not going to submit it to the government on my quarterly payment. And then if it's not forgiven, I'll just return it to the employee. And what the IRS guidelines that came out on August 28th said is that you cannot do that. So if you withhold from the employee, you must actually pay that on your quarterly filings. And if you don't withhold from the employee and those reportings do come due in the first quarter of 2021, you, the employer, are responsible for it. So we, over the last couple of weeks, again, this went effective September 1st. And to date, I've spoken with one employer who's actually participated and done that. You're not required to offer that as an option for your employees. So some employers have just said, we're not going to because we're not willing to accept that liability as essentially a loan holder. Most have said we're not going to because our payroll system doesn't support us withholding it. So what we've seen is that there's a lot of things that happen if any of you manage or run payroll in the background for a payroll process to happen, for all of the calculations to happen. And none of the ones that we've seen are to date set up to be able to actually accurately process withholding Social Security tax deferral. So I've not seen it applied. I've heard of one company and we actually asked and said, hey, how are you doing it? And we haven't heard back yet. So I'm interested to hear if somebody is doing it. Shoot me a message at the end. I'd love to hear about it because we really are trying to understand how people are doing it. But more questions than answers. There hasn't been any more clarification. This is not like Families First, the FFCRA, or any of the other stimulus packages where it's a forgiveness or a credit. This is truly just a deferral. So it's really important to understand the deferral piece of this and to make a decision with intent about whether or not you're going to offer that. Okay. Moving on, everybody's favorite topic, Families First Coronavirus Response Act. Wow, in the world of HR and employment law, I think in the last 9 months, we sat down once, our HR advisory team, and looked at all the things that have changed and all of the new rules, and almost everything has been touched. Leaves, pay, accommodation, you name it. There's a new rule that comes along it. So the Families First Coronavirus Response Act was one of the first legislations that was passed. This is before the CARES Act. I'm going to talk at a very high level because I'm sure many of you have listened to webinars to death on this topic. But in short, if you have under 500 employees, you're required to participate in the FFCRA. And the FFCRA essentially provides paid leaves in a couple of different categories. There are 3 main buckets. There's the emergency paid sick leave, paid at 100% with a max cap. There's the emergency paid sick leave, paid at 2/3 your regular rate with a max cap per day. And then there's the expanded emergency FMLA, which is paid at 2/3 the regular rate, which has a max cap per day. All of those there's reasons, there's eligibility requirements, there's checklists that you need to follow. So I'm just going to talk about some of the things that we see people kind of misstepping on. I'm not going to dig deep into this, but I want to talk about the missteps. So The first misstep is not understanding that there are two regulatory agencies that are giving you guidance on how to roll out Families First effectively. The first one is the Department of Labor, which most people are very familiar with, particularly if you're leading the HR functions in your organization. And the Department of Labor has a FAQ website. I think when I checked last week, I think it was like 103. So they really have been updating it regularly. I think I found that to be a very beneficial tool. It's a lot of reading, and what's important to note is that when they update something, so perhaps they answered something 5 months ago, and now the answer is different today, which has happened in multiple situations. They don't necessarily put a notice out that that's been updated. So you really do have to proactively go out and reread it regularly, or be partnered with a law firm, employment, whoever it might be, somebody who's kind of reviewing those regularly. And like Aubrey said in the beginning, everybody knows what they know today, and rules and perspectives change all the time. So if you go back to the very beginning of Families First, which was in April when it went into effect, the amount of things that changed on, can it be intermittent? What about overlapping FMLA if they've previously had FMLA? What about accommodations? How do we pay that? How do we track it? All of those things have changed over time. So it's just important to know that just because you know it once doesn't mean you know it forever. You have up on your screen kind of a flow chart that just really simplifies how you can decide if somebody is eligible for FFCRA dollars. And it's important because as an employer under FFCRA, if you're under 500, you're required to participate and provide these paid leaves. You're also eligible to receive credit for paying those leaves. So the idea is that you don't, as an employer, you don't have any money that essentially is a loss for you. Somebody's out and you're getting repaid by a credit or an advance credit through the IRS. So that leads us to the second regulatory agency that I think not all leaders are as familiar with. And the IRS has its own set of FAQs for the Families First Coronavirus Response Act. And it's solely focused on how do you claim those credits? What do those tracking things look like? How do you determine eligibility? So for example, the Department of Labor might say, hey, you can't require a doctor's note, but the IRS is saying, hey, you need to be able to show that you verified their eligibility. So there's two agencies, both important, both doing different functions. One is providing for the rights of employers and the rights of employees and giving employers guidance on how to support those. And then the IRS does not play that role. The IRS says, hey, we're just looking at credits in, credits out, how do we track that? So it's really important to understand those two. The other thing with FFCRA that's very important, and if you only walk away with one thing today, walk away with this. You have to have it tracked in your payroll system. If you are giving somebody an FFCRA leave, let's say it's emergency paid sick leave, and you don't code that in your system, in your pay, your actual pay, so they're paid with that payroll code. At the end of the year, when you do your W-2s, you're going to have a lot of headaches. And when you file your quarterly 941s, you're going to have a headache. So you really need to have 3 payroll codes in your payroll system. The first being emergency paid sick leave at 100%, emergency paid sick leave at 2/3, and then the expanded emergency FMLA at 2/3. Having those codes is important because at the end of the year, they have updated guidance and said on the W-2, you need to actually have a line that shows for every employee if they were paid that. They've given some flexibility saying if you don't have a line on that, you can have, say, reference an addendum and you have to file a different form. But at the end of the year, you need to do that. And the reason that that's important, it's easy in HR, and I'm just under 20 years of HR experience. I've been living HR since I graduated from college, so I get it. And I love working with CPAs because they help me see the other side that just we're providing it to employees and it's a service for them, but also at the end of the year, as an employer, we've got all these credits we've applied for on our quarterly 941s for FFCRA dollars. There's going to need to be a reckoning, a balancing, right? So I'm saying paying out these dollars, what employees are claiming them, because each employee is only eligible for a certain amount. So if you haven't done any research into this yet, again, I could do a whole hour section just on this one topic when it comes to pay, credit, what you need to be tracking, how you set up the system. There's a lot of great things there. You'll have my contact information at the end. Please feel free to reach out. And this form right here, as well as a payroll processing one, talking about how to do this, are on our company's website, and they're 100% free. So they're there, they're available for you on the website, or the PowerPoint when you get it, it will be on it. There's a hyperlink, but it does provide all of this information. You don't need to be a client to get it. You don't need to reach out to get it. You can just download it right from the website to have some help. Okay, the next thing I want to talk briefly about, and it's going to kill me to only be brief about this because I just have so much passion and it's such a muddy area, but I just want to briefly talk about it, which is the FFCRA, the ADA, the MHRA, executive orders, and what does all of that mean to you? So it's really important to note that the FFCRA did something really historical, actually, in that there's never really been for small employers a requirement, even for large, for paid leaves, right? So there has always been FMLA out there for employers of 50 or more. If you're in Minnesota, there are some other ones around that. You might have parental leave. But the FFCRA said, no, everybody has to provide it. So if you're an organization that's never had leave that you've had to process before, you really need to be doing some of the legwork to make sure you're following their processes and not stepping in kind of those landmines that get confusing. What that does too is that you have the FFCRA and leaves. You also have the Americans with Disabilities Act, which covers accommodation requests, right? And that's where you can see on your screen applies to employers who have 50 or more employees. But less known is the Minnesota Human Rights Act, which essentially covers everybody who works in the state of Minnesota. And if you've been keeping up on Governor Walz's executive orders, you can tell that if you've been keeping up on the Department of Labor's FAQs, the IRS FAQs, all of the CARES Act details when it comes to evictions, rental collections, you could pay somebody to sit and read all day long just to stay up. One of his executive orders that really kind of flew under the radar, so unless you were really truly reading through all of his executive orders, was one that made a very important connection. So previously, the Americans with Disabilities Act has a requirement to participate in the interactive process. And the interactive process, again, I could spend days talking about what that means. But in its simplest form, the ADA, so the accommodation, requires that you have a back and forth conversation with an employee who's requesting an accommodation to determine, is there an adjustment we could make? Is there something we could change? What can we do with that? The Minnesota Human Rights Act, which covers all employers, has never had that explicit language in there that's been as precise as the federal ADA law. Governor Walz's order said, our expectation is that any employer who, and I'm paraphrasing, so don't quote me on this, but any employer who has a request related to COVID, our expectation is that they engage in the interactive process. So essentially saying what we all knew anyways, and we knew this was going to happen, the litigation already in the system has made it clear, that you need to be engaging with conversation, and that the idea that you have a blanket no in any topic related to this is just really unwise practice to have in place. So what does that mean? That means when we talk about COVID-related requests, and this, again, I could spend hours about, if someone requests, I need to work from home, I need an alternate schedule, I need to have 3 days off a week, I need to do certain things, I need, let's say I need to take a week off, whatever it might be, and the request is related to COVID. If it doesn't fit into FFCRA, step one, does it fit into FFCRA? Is it eligible for that? There are very clear guidelines, very clear standards about what does and does not, and what you should do with that. If it doesn't, you don't get to blanket no. You now need to engage in this conversation with each employee. And it really is the conversation, well, what are you looking for? We're seeing a lot of questions around, the most pain points are around an individual's own health condition that puts them at higher risk for concerns if they were to catch COVID. So the CDC, Department of Health, there's a very well-known list of prior health conditions that increase your risk factor. They actually rate them. It's like from 1 to 6 for your risk factor. we know what those are. If it's related to that, essentially that's a reasonable accommodation request, and you need to engage in that conversation and determine what things can we do. Is our workspace a safe workspace? You know, Governor Walz required that every Minnesota employer has a safe work practice when he reopened. I think that was in phase 2 that happened. If the request, the second thing we see a lot about is a request related to my spouse has an underlying health condition that puts them at high risk, or my child has one, or my roommate has one. So pick it, we call it 7 degrees of separation. And so then you need to be really, truly consistent and really thoughtful about determining what is an accommodation request, who has the coverage here as the employer, and what are our options. So again, I would just leave you with, if you would take one thing away from this when it comes to this, is if you don't have experience with accommodations, with having a process, with understanding how that works, I would just make sure you go out to become informed on that, and to not, there's a lot of litigation around accommodation, even before COVID world. We're seeing it come through already. There are already claims, litigation in the system about types of things like this. So a very common thing that we heard before COVID was an employee would come in with a request to work from home. I need to do remote work because I have OCD. I'm afraid to drive. Let's say I broke my leg and I can't drive, and it's my driving foot. And employers would say, hey, we have a well-established policy of we don't have anybody work from home. You know, everybody has to be in the office. Here's why. Well, those rules are kind of out the window because everybody worked from home for a period of time. So really get clear about what roles in your organization have to be in office, and understand why. It can't just be because you like it, because your culture says that, because the owner of the company says, well, this is how I do business. That's not a qualified reason to say that. So you can't rely on some of those things that you always have before. So we see a lot of questions coming in on this. Again, I could talk for hours on it, but I won't. I'll save you from me. Okay, so the next thing I want to talk about real briefly is responding to COVID-19. So we like to joke when an employer says, oh, I haven't had that happen yet. We say, well, it's going to. For sure, it's going to happen. If you haven't had a COVID-19 positive employee yet, or somebody who says, hey, my spouse, partner, roommate, child tested positive, it will happen unequivocally. So be prepared. We have right here, again, this is free. It's a resource we created. It's on our website. Our website has a COVID-19 response section, which all of these forms are just free. You can just go on, anybody can go click download, and talks about what you should do. I want to address some of the main questions I get around this. And the first one is, what does OSHA require of me? What do I have to do? And what I would tell you is that there aren't very many requirements when it comes to what an employer has to do in response to COVID and to prevent COVID when it comes to OSHA. There's a lot of guidelines, and the guidelines give some recommendations, some are very strong. What you need to be following is the Safe Work Practices program that you put in place as a Minnesota employer through phase 2 of Governor Walz's executive order. That executive order required that every employer has a safe work practices policy. Things like masking inside, 6 feet of social distancing. Do you need to have plexiglass? Do you provide masks? My employer, for example, we have a sign up in the office to make sure that we're always hitting the right occupancy. There are little door hooks to pull doors. There's masks. There's hand sanitizer. You're not allowed to do in-person meetings in a conference room unless you can all sit 6 feet apart. So those types of things are in place. And the reason, if you haven't had a COVID-19 positive response, the reason those things are so important is that when you have a positive response, if those things are in place, your response requirements are much less. So the goal here is that you have safe work practices. So if somebody unknowingly comes to the office with a positive case of COVID, and we know that that happens because somebody may be asymptomatic, or they can be, what we know now is that you can have the active case for 2 to 3 days before you start to show symptoms. So if somebody's at work, it's possible and probable that somebody will come and eventually not know. But if you have those safe work practices in place, then you can go through the process and say, okay, you were at work today, Bob. and you just reported to me that you have a positive COVID-19 diagnosis. So, okay, tell me the safe work practices that you were following. Is there anybody that you were in close, meaningful contact with? And the CDC and OSHA has defined that by more than 15 minutes. So have you been in close, meaningful contact with anybody for more than 6 minutes? And were you masking? And did you exchange tools? Have you been using your own tools? So that will help you identify those things. The two takeaways from this topic that I would like to give you, again, I like to give a couple of quick, if you only take one thing, take these. The first one is your response when somebody says, I'm positive, my roommate's positive, my husband's positive, my kid is positive, my brother's sister's mom, employee is positive, my neighbor is, or they're not positive, but they have the symptoms. Whatever they bring to you, your standard response should be, thank you for telling me. Have you contacted a medical provider and gotten a recommendation yet? And contacted doesn't mean go in and see an office. Contacted means they can just call them. And that's critical because that's what triggers all the FFCRA coverages, right? So they all say based on a medical provider, have you been told to quarantine? So an employee can't self-select a quarantine. They can't say, hey, my kid came home from school and somebody in their class tested positive, and so now they have to stay home. And so now I am going to self-quarantine. No, I need to call my doctor, and my medical professional has to tell me, should I get tested? Should I self-quarantine? Should I do none of the above? Side note, that's actually what's going to happen if it's a school scenario. There's been some interesting changes there. So you want to have that person talk to a doctor, and then once they give you the doctor's recommendation, you follow that. Be prepared that you might get different recommendations from different medical systems. So different healthcare systems have different standard operating responses for that. So some might be 10 days, some might be 14. Some might say always get tested. Some might say don't bother getting tested, just assume that you have it, right? So if you live in a household and 3 of your people have tested positive, many healthcare providers are saying, consider yourself positive. I've just told you, you have it. Don't come in unless you have symptoms and you need assistance, and then get tested. So follow the healthcare provider's recommendation. You don't want to be the one who's making a decision about that, because that really is not, it gets into sticky territory. The other thing is, in small organizations, it's really hard, when we say the statement, the right to privacy, every employee does need to report to their employer if they have COVID symptoms, if they tested positive, they need to do that. The employer has to go through the process, either this form that you see or something else, to determine, okay, who else was at risk, who was in meaningful, consistent contact, who do I need to notify? And let's say it's a department of 3 people and one person tests positive for COVID. So they've been there for 3 weeks and all of a sudden on Monday they're not. And you determine, hey, these 3 people had meaningful contact, meaning they were within 6 feet for more than 15 minutes. We think some of them had their mask off. We think they shared tools. So we're going to notify these 2 to contact their healthcare provider. And those 2 say, well, who is it? And you say, well, it doesn't matter who it is. I'm telling you, you've been in contact with somebody. Here's the steps we want to take. We need to provide privacy and confidentiality. And those 2 are saying, well, of course, it's Bob. There's only 3 of us on our team, and we're here, and Bob is the only one who's gone. And you can say, well, you can make whatever guesses you want. My role as an employer is to say, hey, we're going to respect people's privacy. What they choose to share is theirs. Our commitment is to your own individual safety. So yes, it might feel silly to be saying, I'm not going to tell you who the person is when it seems very obvious, but it's critical as an employer that you do that, because we don't have the right to share who had the COVID-19 symptoms or positive diagnosis. We have an obligation to share somebody's had a potential risk of exposure and they need to contact a medical professional. Okay, that was my elevator speech on all of those things. I could have gone for hours on those. There's so much to say. I hope if you have questions that you ask them. If you have a question, I promise you somebody else has had the same thing come up. You'll see here my email address and my phone number are on here. Please feel free to reach out to me, shoot me an email, give me a phone call, and I'm happy to get you connected with the right resource and or answer questions that I'm able to and help you as you try to solve all these problems in the COVID world.
Great, thank you, Brenna. That was excellent. And Last but certainly not least, Matt Goldfine. I will give you control.
All right. Looks like I have it. Well, thank you so much, Aubrey, and MHA for having me. My name is Matt Goldfine. I'm an attorney at Burdick Lifton here in the Twin Cities. The topic I'll be discussing today is evictions under the CARES Act and eviction moratorium. I know this isn't everyone's favorite topic, and no one really wants to evict anyone from their properties, but sometimes it's an unfortunate thing that we have to do. And so I wanted to go over the rules and regulations in place now related to evictions, what you can do, what you can't do, and some options that you have at this time. I will start by touching base on the CARES Act eviction moratorium. As many of you are aware, the moratorium was put in place by the CARES Act, which covers covered dwellings, which would be essentially any residential property that is considered covered property. Covered properties would be places such as locations with Section 8 housing, Section 42 housing, affordable voucher programs. In addition, it would be rural housing voucher programs, and then also federally backed mortgages and federally backed multifamily mortgages. And with those, there's also the consideration needed to, did you receive any assistance from a federal officer or government official with your mortgage? So all of those types would be considered covered properties here. From doing some searching, I believe the guess is that that covers about 25% to about a third of properties. So this isn't dealing with every property, it would just be the ones that are covered. The main portion of the moratorium went from March 24th, 2020 up until July 24th, 2020. And during that time, the prohibitions were from bringing evictions for non-payment of rent cases or non-payment of other fees and charges that tenants might incur under their lease. In addition, there was the, you cannot send a termination notice or notice to vacate for these properties, and you cannot charge late fees during only that time frame, so from March until July. As far as questions with the CARES Act now, what still remains of the moratorium is a 30-day notice requirement. And so with that, we receive a lot of questions. Is that for all evictions, or is it just the non-payment of rent cases? Our argument and what we believe is the case is that would only be for non-payment of rent cases, as it wouldn't make much sense for Congress to enact a bill where you didn't have to have a 30-day notice requirement during the moratorium for cases such as serious endangerment or things of that nature, but then all of a sudden you have to wait 30 days to file a case where other tenants are in dangerous situations based on the actions of a tenant or a guest or an occupant. Another question that is frequently asked about the 30-day notice requirement is it's going to last forever. In Minnesota, while you're in your lease, there is actually no notice requirement for filing an eviction. So this would be new to Minnesota. And since this is not being litigated at this point, as what I'm going to touch on briefly, the Minnesota eviction moratorium, this is something that we're still waiting on guidance from the courts on, and might be a ways down the road as we continue our current moratorium. I know many states are kind of go back and forth on this. Some have said, yes, the 30-day notice requirement only lasted from July 24th until the end of August, or 30 days from the 24th of July. Whereas other states have indicated that this is ongoing. There's no sunset here. So obviously this is something that will be addressed in Minnesota at some point. It just has not been to this time. And that's because of the Minnesota eviction moratorium, excuse me. So the Minnesota eviction moratorium started right near the beginning of the pandemic. It's gone through a couple modifications to this point, including one in July of this year, which is Executive Order 2079, which actually went into effect on August 4th of 2020. This is the order that currently controls evictions in Minnesota. So this is the one we're relying on when we're making determinations of what we can do at this time, what we can't do at this time. As you see on the PowerPoint, prohibited eviction types would be holdovers after a notice of termination of lease, notice of non-renewal of the lease, termination of the redemption period for a residential foreclosure, most breaches of lease, including material violations and non-payment of rent cases. So this covers many types of evictions that we would typically bring before the pandemic. Some of the allowed types would include serious endangerment of the safety of other residents, crime-free, drug-free violations, which includes controlled substances, prostitution, unlawful firearms, and stolen property, material violations of the lease for serious endangerment of others and significant damage to property. And I will note that you'll notice that there's two different types of serious endangerment here. One is other residents. That one you can bring evictions for regardless of what the lease states. For the serious endangerment of others, which would include staff, guests, other people on site, and for significant damage to property, we would be required to have some term in the lease to indicate that that's a material violation. One other area that we have brought some evictions in would be evictions not listed in the prohibited section, which we discussed briefly above. Those would be like nuisance, unlawful detention, especially with nuisance cases. It would be kind of serious nuisances. But our argument there is if the eviction moratorium does not address these topics, which it doesn't, that we should be allowed to bring those evictions, and we've had the courts agree with us on that. As I mentioned before, the state of Minnesota did not have a notice requirement for filing an eviction while you were in lease. That has changed with Executive Order 2079. There is now a 7-day notice requirement of intent to file an eviction. So that's important to note, as a lot of these cases are very serious with issues of resident misconduct, and even in any single case that involves serious endangerment and things of that nature, we still have to give a 7-day notice requirement. And therefore, we always advise our clients to get the information together so we can provide that 7-day notice requirement. And actually what's ended up happening is if tenants realize that their conduct has really violated their lease and that they should not still remain a tenant, they have ended up vacating before filing the eviction. Another thing that's changed is now most, if not all, writs can be executed. So there was a period of time where the executive orders indicated that you could not execute on writs if you were the sheriff. And so that has changed in the most recent order. So we work closely with sheriffs to see if they interpret it the same way and if they're willing to help remove issue tenant from the property. So I'm sure everyone wants to know, how long is this going to last? The real answer is I am not entirely sure, but the eviction moratorium is tied to the peacetime emergency, which is set to expire October 12th, 2020, which is just around the corner. I did read last night an indication that Governor Walz will be extending it again. And so it will be extended for another 30 days. And then at that point, it's possible it will be extended further. That's yet to be seen, as everyone's discussed thus far in their presentations, that there's so much changing, there's so much unknown here. So it's kind of just waiting to see what the governor, what the state legislators, what the federal legislators are going to do. So another eviction moratorium, because we have many in place right now, which some of you may have heard of, is the CDC eviction moratorium. Part of that moratorium states that it will not preempt states that have more coverage in their moratoriums. So we discussed this with local counties who have indicated that their belief is that our moratorium is not preempted in any way by the CDC moratorium. There is questions, and there are going to be arguments made as to if the CDC moratorium is stricter in certain requirements, will that provide those requirements, and then the Minnesota moratorium will provide the rest. That's unclear at this time, but our reading of the CDC eviction moratorium is it only applies when the eviction or when the state's protocols are less strict than the CDC moratorium. This goes up until December 31st, 2020, but again, it could be extended. It's unclear at this time. And it is a very unique step that we really haven't seen before, of the federal government not passing a law, but an entity of the government providing the moratorium. So there's certainly going to be challenges to it in other states that are currently dealing with it, but we have not heard yet if what the results of those challenges have been. So what's the difference between the CDC moratorium and the Minnesota moratorium? For one, the CDC moratorium allows for breaches of lease cases, which is a big difference from the Minnesota moratorium. So we have cases these days where there's certainly breaches of lease, there's noise violations, or there's other issues that are constant and frequent at our properties, or properties abandoned. And unfortunately, if they're just breach of lease cases, we can't bring them right now. We need to show serious endangerment, we need to show significant damage to property, things of that nature. So that's one component that if we were to move to the CDC moratorium, it would certainly assist in allowing us more access to the courts for matters that are affecting the enjoyment of all residents as a whole, as opposed to just the individuals who are causing the issues. In addition, there are certain requirements for quality protection, or there's requirements to qualify for protection, I should say. For Minnesota, it would be every residential tenant. If we're dealing with the CDC moratorium, there's more strict requirements. Those include lists that you have to use the best efforts to attain available government assistance. There's an earning requirement of $99,000 for an individual, or $198,000 for a couple. You're unable to make rent payments at this time due to loss of income, loss of jobs, extraordinary medical expenses, things of that nature. Using your best efforts to make partial payments for any amount that you can pay, and then that the eviction would cause homelessness, or for you to be in close proximity to other individuals who are not in your family. So there's a big difference in who would qualify under each. One component of the CDC moratorium is that you need to sign a declaration and provide it to whoever has the ability to file an eviction. So that could be the owner, the property manager, or anyone else who has access to the courts to say, hey, we believe that we're entitled to remove this individual, or to have the courts remove this individual from the property. Under both moratoriums, the obligation remains to pay rent. So what that means is no rent is forgiven here. No, people who do have the ability to pay should still be paying rent. And so it's important that they know that, this does not waive their requirement to pay rent. Additionally, neither one references late fees. So our understanding is you certainly can bring late fees on to people's ledgers at this point, or in addition, if there's any other charges under the lease, they are required to pay them. You can't evict for those reasons at this time, but they are requirements. A question we've been receiving about the CDC eviction moratorium is there a deadline to submit your declaration? So every tenant needs to provide it, not just one tenant in a unit. When can they bring it? Can they provide it to you after you file an eviction? Can they provide it to you even after a case is being heard? What's the timeline for that? It's not entirely clear. We are aware of a case in Iowa that actually settled, so we didn't get a final result, but a declaration was provided during the hearing or just before a hearing, and the court actually took testimony to understand if all the qualifications to meet the CDC moratorium were met. And so it is unclear here in Minnesota. It's certainly a risk to file an eviction and try to go that route because the penalties are very steep here if you don't succeed in your argument that the declaration's invalid or you're entitled to an eviction at this time. So what's next? To be honest with you, as I mentioned before, we don't know because everything is changing so quickly. I spend many hours looking at bills through the state and federal level and other indications of what Governor Walz is going to do in the state of Minnesota, as everything's changing frequently, and it helps provide guidance as to what's coming. But at the end of the day, until there's agreement between the Senate and the House and the governor or the president is going to sign the bill, we don't really know. So one example is that at the federal level, the government started working on the HEROES Act, or the House has, that would essentially replace the CARES Act, or at least provide additional benefits and additional requirements. The HEROES Act actually has a 1-year moratorium for failure to pay rent cases. In addition, it has some late fee requirements and other specific requirements related to rental properties that has actually passed the House twice now, once with a full spectrum of I think $3.3 trillion in aid, something like that. And so that bill has actually been kind of shortened a little bit, but a lot of the changes have not affected residential rental properties. Our understanding, at least what Representative or Senate Majority Leader Mitch McConnell said, is that's a non-starter. But there are discussions ongoing, so that it's very possible there's going to be a bill in the future that affects residential rental properties and multifamily housing. At the state level, there's also been bills that have been proposed that affect extension of the moratorium past the end of the peacetime emergency, requirement to not charge late fees, not terminate leases or provide notice to vacate. Many of those have stalled, and since we're only in special sessions each time the governor renews the peacetime emergency at this point, they have not been brought back up yet. Another thing to consider is the governor has modified the eviction moratorium a few times during the pandemic, and so it's entirely possible he'll modify it again. He could change it to allow breach of lease cases. He could make it more restrictive. We're not sure, but certainly there's advocates for all sides involved indicating what's the best step here. So we're evicting only the people that are really harming others in the building, but allowing everyone else to stay safe and healthy during the pandemic. So a lot of my discussion here today has been about what you can't do. So I did want to leave you all with stuff you can do at this time and let you know that you do have options. If you're having any incidents with an individual at your property, please reach out to an attorney. As I discussed, there are exceptions to the eviction moratorium, and there might be things you're not thinking of that we can kind of tie together to help alleviate the issue, whether it's bringing an eviction or otherwise. We do have clients that have been working with many tenants on payment plans, cash for keys offers, and other incentive programs. These are also very helpful. Sometimes people are very receptive to a payment plan or a cash for keys or just a clean break. I think a lot of tenants are very stressed about what happens at the end of the peacetime emergency or the pandemic related to paying rent if they have a lot of back due rent, and sometimes there's value to just agree to a clean break of a mutual termination agreement for a certain day and for them to vacate the property. I'll touch on this a little bit later, but we do have a client who's indicated that they're actually offering gift cards for individuals to come down to the office or meet with them via Zoom to discuss rent assistance programs, because there's a lot at this point. So there's ways to get creative here, and certainly put together programs that are going to help alleviate some of the stress of the pandemic. One thing I would suggest with any of these is to avoid communications that can be perceived as harassing or coercing tenants to proceed in a certain way. The one thing we don't want to do, and it's a requirement of the executive orders at the state level, is force someone out. Cannot terminate a lease, nor do many people want to for most cases at this time. So we don't want it to make it even appear as we are. We have received calls from the Attorney General's office asking about the practices of our clients, and every single time thus far we've explained the situation and they've understood and know that we have the best interests at heart, and it's not harassment or coercion. But we don't want to get to that point, certainly. The next thing I would say is contact your local county about rent assistance programs. They have lots of money right now. We have shareholder meetings with Hennepin County, Ramsey County, Dakota County all the time, and those individuals are on the call and say, received a lot of money from the CARES Act, from the state level, and we want to provide that. We want to get people out of rental debt. And so contact them. If they have resources, they'll provide them. If they have indication of others with resources, they also are more than willing to provide that information as well. So the other thing they'll do, which I thought was interesting, is they'll actually come to your properties and sometimes write checks right then and there to the property managers, the owners, or people who are receiving payment. So that's another built-in bonus, is that the payment won't go to the tenant, or it will have to be processed, and then you may or may not receive it. It will go directly to the property management company. And then the last thing I'll just leave you with is do what you can to address concerns of other tenants. It's a tough time for everybody. I know everyone's working to have creative solutions to address problems, whether it's noise complaints or other issues with everyone in their properties all day, every day. This is important for obviously tenant morale, but also we want to avoid any litigation for rent escrows or other cases where they argue that their property is not fit for the intended purpose. So it's very essential that we're doing what we can. I mean, we have to make reasonable efforts at the very least to try to come up with solutions. So make sure that's something you're focused on when you're receiving complaints from tenants about other tenants or issues in the building. With that, I have nothing further in terms of my very brief review of the moratorium. So I will pass it back to Aubrey for questions.
Thank you very much, Matt. I will invite our other panelists back on the line, and we will do questions. And we do have questions coming in. So let's start with a question for Jody. Let's see here. Someone is saying that their wife was one of 4 owners of a corporation that owned a number of apartment buildings. In 2017, the corporation dissolved and she retained ownership of 2 buildings. Is she able to use cost segregation for improvements and renovations?
Yes, she should be able to. That was 2 years ago, you said that she inherited, or
2017, the corporation dissolved.
Yes.
Great. All right. And a question for Brenna. We have an employee with a child in school. The school offered both in-person and distance learning as an option. The employee chose distance learning for their child. Do they qualify for FFCRA?
Good question. So the short answer is maybe and probably not for some of those days. Everyone loves HR. We're like, maybe, let's talk about it. So FFCRA, the emergency expanded FMLA coverage for 2/3 pay does cover if your child's care is closed, that includes school or a child care facility. So it's important to know the age. So the IRS has set guidelines for certain ages, right? So if you're a 15-year-old and your school is closed and you have to be home alone, the IRS has said, sorry, you can do that if it's during the day. You don't need a parent home or a guardian. When it comes to schools that are back in school now, so we've got school has kind of returned in most districts in one of three ways. Either you're all in during the day, you're all distance learning, or it's hybrid. And the hybrid model in this question where it's one of two things. Some districts have said, so for example, I live in Minnetonka School District, and Minnetonka School District offered full in educational learning for my kids' age. They could either go to school 5 full days a week, or you could elect to do 5 full days a week distance learning at home. In my situation, if I had said, hey, I'd like to do distance learning, so my kids are going to be home, and then I went to my boss and said, hey, I need FFCRA leave because my kids are going to be home. And she said, well, can you tell me about the communication from your school? What were your learning options? I would not be eligible for FFCRA because I had an in-person option, and essentially I just chose to keep my kids home, right? So FFCRA is your school is closed and you're not able to be there. So on its face, if they had an option to be in school, the answer is no. Some caveats to that are this. Some districts said all students are some in and some distance. So a lot of districts said your child's going to be on a rotating schedule, in 3 days and then home 2 and then in 2 and home 3. Some of them have like 5-point Gantt charts to cover what days they're in school. I mean, it's insane. So in those cases, the days that they are home would be covered. So the days they have to be at home, they don't have an in-person option, would be covered by FFCRA. The other ones would not. The other caveat is they might not initially be eligible, but then if somebody in their school, in their class, tests positive or something happens and their child is sent home for that 2-week quarantine period, then they might become eligible again. So it's a moving target. The short answer is probably not if they have an in-person option, but you need to ask more questions and understand to get clarity around it.
Great, thank you. Next question is for Matt. There is a little bit of confusion on what folks are allowed to evict on in Minnesota as of right now. Can you just very briefly, a few points, say what is allowed, what is not?
Sure. So I think, and there's confusion, to be honest, among attorneys and the courts as well, because a lot of these rules are new. So what is serious endangerment? What is significant damage to property? Those are things that the court is figuring out at this time. Serious endangerment, I mean, I think we know some of the obvious answers. There's fights, there's stabbings, there's gunshots, there's just making the environment dangerous. I know we had a case a while back where there was a drug user who had needles throughout the building and things of that nature, or another case where an individual was starting small fires. So we successfully argued that that would be serious endangerment or significant damage to property, but it's not entirely clear. So I think it's really about the totality of the evidence. What do we have to show either of those two concepts? Certainly if there's controlled substances in the building that we have significant or sufficient evidence about, or prostitution, or firearms, or stolen property, those things would also qualify. And then beyond that, it's really, we've been making arguments to the court about things that don't meet the definition of prohibited evictions in the moratorium. So it's not entirely clear. Certainly contact your attorney, contact us. I'm happy to discuss with anybody these circumstances, but our argument would be everything that's not listed in the Minnesota eviction moratorium as I discussed in the presentation.
And just a follow-up question on that. So to be clear, owners and managers are not allowed to evict for non-payment as of right now.
Yep, that's correct. And so that would be the case whether we're in the Minnesota moratorium or the CDC moratorium, non-payments off limits. And as I discussed briefly at the end there are options to work with individuals who refuse to pay. Some people are going to just say, no, I'm not paying, and yes, I'm staying here. But I think oftentimes if you work with the tenants, they will be receptive to one of a number of options you provide them, especially because it's stressful as a tenant if you're unable to pay at this time or can only make partial payments. So reaching out without harassing is certainly the way to kind of get their attention and hopefully come together on a discussion and work with them on rent assistance, because they're the ones who need to apply, and shockingly just not many do, even if they know about it. So if you can get them to apply, that's most of the battle there in receiving oftentimes big chunks of payments for how much they owe.
Great. And just a follow-up question about the assistance right now. The tenant must apply for the assistance. That's correct?
Yep, that's correct. So as far as we've heard from assistance programs, I'm not aware of anyone's that are landlord or owner or property manager of applications, but like I said, we have some property management companies that are using very unique ways and other ideas to get people to the table to fill out the application, because it's no harm to the tenants to apply. So if it takes a $10 gift card to get them an application that can get you rent assistance, I think that's a great deal personally. But there's other options and other creative ways to convince these individuals to apply.
Great. Another question for Brenna. Do you have to deplete your PTO before applying for FMLA or other programs?
Good question. I'm going to answer that two ways. One, assuming the question's about FMLA, and two, assuming it's maybe about FFCRA. So FFCRA and FMLA are two different things, unless you've never had FMLA before. And then, isn't this so fun, you guys? Everybody's like, what is ever? Matt's like, maybe, we don't know. Jody's like, it could happen, right? COVID has created so much ambiguity across the board. It's great. So FFCRA provides emergency paid sick leave and emergency expanded FMLA for organizations that maybe previously never had any FMLA. So if you were previously covered under FMLA, which is the Family Medical Leave Act, whatever your policy was around requiring use of PTO, allowing people to keep it, you've got all those things in place. That's just a traditional FMLA. Under the Families First, you explicitly cannot require them to use PTO first. So the EPSL, the Families First dollars, so the EPSL, which is that emergency paid sick leave, and then the expanded FMLA, they explicitly state you cannot require that. So if an employee wants to, they certainly can. That's up to the employee. I've yet to actually have any employee who chooses that first. I don't know why they would. But if they want to use FFCRA and they've got a bank of 250 hours of PTO sitting out there, they still get to use FFCRA first, because the FFCRA dollars are credited back to you. So you're not losing them. Kind of that regulation is all about, we want the employer to make the employee whole, and then we're going to make the employer whole. So it's a little circle that's supposed to work great. So the answer for FMLA, non-COVID related, is it depends. What's your policy? What's your practice? What do you have in a handbook? All those types of things. The answer related to COVID and FFCRA is they get to use FFCRA first over and above everything else if they want to. And if they don't want to, they don't have to. They can choose it. But again, I don't know why. I mean, as of today, it expires December 31st. Like Matt said, we're looking at crystal balls every day where we have like legislation alerts up, or, the HEROES Act. President Trump just in 24 hours has said, I'm not talking to anybody about it. And then also, okay, I'll talk a little bit. So who knows? It's like every day is a different speculation. So it's only through the 31st, and it depends.
And I know we're running out of time here, so I just would like to note real quick, please feel free to contact me too. I apologize for not having my contact information at the end of my presentation. My email address is M as in Matt, so my first initial and then last name @bernickliftsit.com. I just wanted to put that out there. I'm happy to answer any questions. There's a lot of confusion here. And there's a bunch of new rules that people are trying to determine all quickly, so.
Can I throw one more update out there too? That I mean, I know Aubrey and Matt and Jody and I all kept saying on our planning that there's so much to talk about, like Matt said, and we could just go on, and we're really going 100 miles an hour through this with details. But I did want to know an update that many people are not aware of. It's not necessarily related to all this, but it is, and that's COBRA coverage. So if you don't have a third-party administrator managing your COBRA notices, so COBRA is what you provide to an employee when their employment ends and or their benefit coverage ends. And previously they had 60 days to elect COBRA coverage that extends their benefits from the day their benefits ended. And legislation has changed that now, and it's essentially open-ended. So let's say hypothetically you terminated somebody in May. They didn't elect COBRA coverage and they don't have medical benefits anywhere else right now. They can come back and elect retroactively COBRA coverage back to the day their benefits ended and not have to back pay that amount of money right now. So if this is news to you, talk to whoever your third-party administrator is. If you do COBRA notices in-house, just make sure somebody's doing that right. It's really important that your COBRA notices have been updated and you're giving the accurate information because it's a major change. And this is an area that people get dinged on all of the time in general. COBRA is pretty complicated because you have all these time windows to do stuff. It's actually similar to evictions and notices. You have to follow a set order of time, and if you miss one, you kind of lose all of your rights with it essentially. So do that correctly. If you don't know what I'm talking about, email me or go look up COBRA extensions and it will be there too.
Great. We are almost out of time, so I just want to thank our panel for this morning. Really appreciate the time and energy, and as they all mentioned, feel free to reach out directly to them for some of these questions that we were unable to get to this morning. Thank you very much.
Thank you.
Thank you, everyone.